want to show how an actual client's living annuity performed, and I want to show how the same client would have performed had he been invested in a hybrid annuity for the last plus minus 22 years. In this research, we looked back at how the client's actual return changed over time as measured by his internal rate of return or his IRR. We then did a backtest of what the IRR would have been if he or she had been invested in a hybrid annuity for more than 20 years, assuming that the product was launched way back then instead of 2022. This is the client's actual IRR experience. It took a bit of a dip in 2008 with the global financial crisis, and it looked like the client switched into a much more conservative fund for the next few years. It is likely that the client paid a behavior tax due to this switch. An interesting note is that annuity rates were much lower than they are today, and as such, the client would have received a much lower guaranteed income for the past 20 years than what a similar person would have locked in at today. In addition, the client retired in his mid-50s, and as such, he had a lower starting income compared to what, let's say, a 65-year-old would have started off with. In terms of the comparison, the hybrid annuity's IRR was negative at first, as expected, but it turned positive reasonably quickly because of the guarantee term. The guarantee term ran out 10 years after the inception of the policy, and from this point, the hybrid annuity IRR gradually closes the distance between itself and the living annuity IRR. It also nicely mimics the COVID-19 dip and recovery in 2020. At the date of the analysis, the client had not yet turned 80, and we expect that the IRRs will cross soon in about 3.5 years. With a guaranteed annuity portfolio, with a starting income similar to what is available in 2025, the crossover would have occurred 4.5 years ago, just after the COVID-19 market fall and correction. So what does it mean if the IRRs cross? If it were to cross today, it means that every payment from the gap is now free cash, as the market value of the market-linked assets in both the investments are equal. To put it into perspective, if the IRRs crossed, and if I assume an initial investment of 2 million Rand, the value of this market-linked assets in both instances would have been 1.4 million Rand today. But the hybrid annuity would have been injected by an additional 174,000 Rand from the gap in the next 12 months. In future, these injections would continue until the client dies, and they would grow by 5% every year. Stated differently, the gap could provide a potential injection of 1.4 million Rand in the next 7 years. That is worth more than the current value of the living annuity. By using a gap, you can reduce many of the key risks in retirement. Risks such as market risk, longevity risk, and inflation risk. To determine the right allocation and type of gap for you, you need a second pair of hands, those of a financial advisor.
This video is intended for educational purposes only and should not be regarded as financial advice. For more information, visit our website or speak to a financial advisor about the guaranteed annuity portfolio from Momentum Wealth.